Hey guys, welcome to Deep Dive Stocks. Today we're going to be going into one of my favorite topics and one of the more interesting aspects of VoEx Spikes. So let's go ahead and get started. So a few things to cover today. So obviously we're going to go over VoEx Spikes, then we're going to talk about the research behind them, then we're going to talk about the back testing, and then finally we're going to talk about the market scan that scans the market for these VoEx Spikes. So what are VoEx Spikes? Well, if you haven't, I would recommend checking out the video on my channel about VoEx to just get an overview of what it is and what it measures. The idea is that VoEx measures a stock's stability, and we can quickly look at if a stock is stable or not based off of if VoEx, this magenta line for VoEx daily, or this tan line for VoEx trend, is inside of stability, so in this middle zone right here, or if it's in this inhibition zone or the propagation zone. Anytime that VoEx moves outside of stability, this indicates that the stock itself is unstable for various reasons, and that can have some statistically relevant price action that follows. So VoEx spikes are a way to measure for sudden instability. And the idea is that they are meant to be easy to read and statistically relevant. So let's take a look. So here's DM on the 17th of March, and we can see that this drastic spike up, so this would be a positive VoEx spike, was experienced. And again, they're easy to see. So if we go through the market and we look at all of Deep Dive stock reports, the VoEx spikes are pretty prominent by nature of how VoEx behaves. And again, they should have, if they're worth keeping an eye on, they should have some statistical outcomes. And thankfully, it looks like they do. So there's a VoEx spike. And in terms of what comprises a VoEx spike, there are two kind of main systems that mix with each other in like the underground, kind of like what some of those things that can control a stock's price without just like supply and demand. And those are the various hedging requirements. So you have delta requirements, gamma hedging, you have hedging against like futures, hedging against swaps, and then you have some liquidity. So that gets plugged into VoEx spikes. So did liquidity suddenly vanish? Did liquidity suddenly arrive to the stock? Does it look like it's artificial liquidity? Is that liquidity even affecting the hedging requirements? So there's a lot that go into the VoEx spikes, but thankfully we don't really need to keep all that in mind because, well, Deep Dive Stocks algorithms find those VoEx spikes for us. So if we look at just a recent example, on the 17th of February of this year, the Deep Dive Stocks algorithms identified a VoEx spike here. And what's interesting is there seems to be a lot of spiky VoEx, but the market scan identified this one as the one that was statistically relevant for future price action, most notably negative price return, as we'll see. So the idea is that these VoEx spikes are why did I put this word in this video if I can't even say it? They're determined by algorithms, right? So we can see the VoEx spikes and we can understand that these VoEx spikes meet the like traditional behavior for VoEx. So VoEx moving into the inhibition zone typically means that this price action is being resisted against. So the price action will most likely fall, which it did as the price kind of fell back to stability. And what's interesting though is as this price began to rise back up, the VoEx became VoEx spiky, so it became statistically relevant for future returns. The market scan caught this on the 17th of February. And of course, over the next several days, the price action fell in line with VoEx's prediction, and the price fell 10.73%. Not too shabby. But seeing these VoEx spikes and working with them, we got to have some good data for it. We have to have confidence in this data. So the first thing we did was we went through the market and we looked at all the VoEx spikes that occurred in the past 2 years. We collected them, and these VoEx spikes had to meet certain criteria. Rather, the stocks that these VoEx spikes were produced on had to meet certain criteria. And the first one was that the average volume had to be greater than or equal to 5 million. So we wanted a stock that had decent liquidity, and the idea that it wasn't like a low cap stock or a low volume stock that was drastically moving the price. it had to be trading for at least 1 year. So stocks, the idea to try to exclude stocks that were undergoing price discovery, and also stocks that had sufficient involvement with the market to tap into the things that VoEx measures. And the third criteria was that we didn't want VoEx that was already inside of stability. So the idea that we wanted a stock that was teetering on instability and then had a sudden shift either in the positive or the negative directions. And that the idea being that those would probably give us the most statistically likely outcomes. And the change in the VoEx, or the Varg spike for backtesting, was calculated as a change in the VoEx of at least 100%. So in the positive direction or in the negative direction. Then we grouped the VoEx based off of various cohorts, as we'll see when we look at the results. And so what did we see? So we identified the spike. So once we found the spike, we identified the spike, then we recorded the VoEx information, and then we recorded the change in the price of the stock over the next 5 days, but we used a modified percent change. So instead of saying, day 1 to day 2, the stock changed 1%, and then day 2 to day 3, the stock changed 2%, we always calculated the change in price from the day of the VoEx spike to the day of that was being calculated. And we did this for 5 days because the idea was that VoEx spikes are sudden spikes of instability. So this should confer some short-term statistically relevant price action, and we didn't really anticipate or feel the need to extend beyond 1 trading week. So what were the results? Well, in scanning this, we identified 12,455 VoEx spikes throughout the market. Pretty healthy number of results. And the first thing we did was we mapped the spike amount, and then we mapped that to the price action. And the results were pretty, honestly, better than what I initially expected, right? So the lines here represent the trend line per the day after the VoEx spike. So we have the 1 day after, 2 day, 3 day, 4 day, 5 day, or this is 1 trading week. And we see that if the VoEx spike was positive, just like we saw on our example where it shoots straight up, we had a statistically relevant so this is a 68% trend line. So statistically relevant to 1 standard deviation in anticipated price returns. So the greater the VoEx spike, the deeper the returns were on almost all 5 days. The negative spikes were a little bit more dynamic. So there were some, if the VoEx spiked down significant, like a lot, like 600 as the spike amount, then positive returns were expected. But if it was in this Goldilocks zone around 300 for the VoEx spike, so that's negative 300, so that means it spiked all the way down, then negative returns would be expected. And we also see that on day 1, each day it gets a little bit more negative from the starting price of the day of the VoEx spike. But that wasn't enough. So there seemed to be some other patterns popping up in the data. So next, we cohorted the VoEx spikes based off of if the initial VoEx was positive or negative, and which direction the VoEx spike was. So in this graph, we have the same as before. So we have the 5 days after the VoEx spike. So we have day 1, day 2, day 3, day 4, and day 5. We have if the VoEx spiked upwards, so if it was a positive VoEx spike, or if the VoEx spike spiked downwards, it was a negative VoEx spike. But also if the initial VoEx was positive or negative. If it was positive, then it's this gray line. And then if it's negative, it's this blue line. And so with this, we can see the evolution of the price action as compared to the closing price of the day of the VoEx spike per each day, depending on if the initial VoEx was positive or negative, and if the VoEx spike was positive or negative. So, for instance, if we had a initially positive VoEx that experienced a spike of, say, 600, then we would go to, on day 1, since it's a positive spike, we look at the gray line, and we go to 600 since it was a positive spike of 600, and we see that negative returns would be expected. On day 2, even greater negative returns. On day 3, negative returns again. Day 4, negative returns again. And on day 5, negative returns again. And what's interesting is we can see how the price change evolves throughout the day or throughout the week. So it even gives a glance that there may be a recovery period in VoEx spikes. And they're overall just really cool to see. And again, these trend lines are statistically relevant to a 68-degree probability, so an alpha of, 32? So an alpha of 32 for the direction of price movement, not necessarily the magnitude. So in a very similar way to the snap graphs on deep dive stocks reports, these are more geared towards helping identify the direction of the price movement rather than just the amount that the price is going to move. But with a probability of 68%, not too shabby. So this gave some confidence to take the next step with VoEx Spikes and start doing some backtesting. So we had some empirical data that showed that there was statistical relevance with these VoEx Spikes and future price return. So we wanted to see how this would translate to a real trading strategy by utilizing a simple, straightforward, algorithmically driven and backtesting. But we also wanted to incorporate some risk monitoring. So we're going to see that there were several variations of the backtest. We did 48 in total, and some had like no risk tolerance, some had a 5% risk tolerance, some had 10, so on and so forth. And we also wanted to start at various points in the market just to make sure that the results of the backtesting weren't confined to a specific point in time, which obviously we could never go back and test with because, well, we're here now. And so how this translated in theory was the market scan would give the backtest the list of VoEx spikes for the day. We would consider that VoEx spike, so there are certain requirements like making sure we didn't already have a position open in that stock, making sure we could afford a position in that stock. And if we couldn't, we would just skip over to the next VoEx spike. If we could, we would enter that position based off of the prediction, which was based off the day 5 of the empirical data. So if the prediction was long, we would enter a long position, and if it was short, we would enter a short position. We would simply monitor this position every day, and this has to do with if there was risk tolerance involved or if we were just holding that position for all 5 days. Then on 5 days, or if the risk tolerance was met, we would simply exit the position, take some profits, and then start all over again. With a little bit more detail, the algorithm that was followed, or kind of like how the trader would follow this algorithm, is here. So starting with the end of each day, just before the close, if any positions were open or going to be open for greater than 5 days, so this was the 5th day, we would close that position. After the close, we would look for the market scan and we would go through each VoEx spike to see if it met those requirements. And again, that has to do with like, do we have sufficient funds to enter at least a 100 share long or short position? Do we already have a position open in that stock? But if we met those requirements, then we would tag that as a potential trade. As well, for after the close, we would look to see if any trades moved against our risk tolerance. So for instance, if we were entered into a trade that had a positive prediction for the next 5 days, but it actually moved negative today, and let's say that our risk tolerance was 5%, we would say, all right, did this price movement move more than 5% against the starting price of the day of the VoEx spike? That's because I have a 5% risk tolerance. If it did, then that trade would be marked for closing at the start of the next day because it's breached our risk tolerance. Then at the start of each day, we simply see if we have any positions that are marked because of risk, and if they are, we immediately close them. Then we see if there are any trades, any potential trades, and if there are, then we enter them. And again, there's no intraday trading, so we simply wait until the end of the next day and repeat the cycle all over again. So simple, straightforward, and there's no profit taking, there's no consideration for one VoEx spike over another. It's a first come, first serve, and it's a very conservative system because you either meet the risk tolerance or you don't, and if you don't, you simply just hold the trade for 5 days. Some of the styles of backtesting, so we tested the type of prediction that VoEx spike gave. So none represents it didn't matter. It was just a first come, first serve for the VoEx spikes. Positive meant that the backtest only utilized positive predictions. Negative meant that the backtest only utilized negative predictions. We have this risk tolerance where there was no risk tolerance. 0% represents if there was any one day where the price moved opposite from the ascribed prediction, then that position was marked as closed. or to be closed. And then we have the 5%, and then we have the 10% risk tolerance. Then we have the start date. So like before we talked about, we wanted to make sure that this backtest or this trading strategy wasn't just suited for more like immediate time frames. So we started the backtest in January of 2019, January 2020, January of 2021, and then April of 2021. And the ending date was the October of 2021. So I had a count. I had to say my dates in my head. So all in all, we did 48 backtests. The results were honestly super promising. Of all 48, 43 of the backtests experienced positive growth. That's with a starting value of $10,000 starting portfolio. Only 5 of the 48 tests had negative growth. And the good thing is that there were some patterns noted in these negative growth stocks to help clarify why those trading patterns did produce negative returns. And 15 of those 48 back tests actually beat SPY on the same time interval that those back tests were utilized. So if we look at the growth per year, we see that if we started in 2019, all 12 of those back testing strategies that started in 2019 experienced positive growth. In 2020, we have 10 or 83%. And we also have 5 of those, or 42% of those back testings beat SPY. And so we see that for every time frame except for 2019, the backtesting actually did a really good job and beat SPY. So in 2021, the majority of the time, but in 2020 and 2021, April of 2021, not too far off. If we look at those that beat SPY, we see that the mean growth for those backtesting strategies was 47.60%, with the median growth of 53.63%, and a maximum growth of 65.78%, and the least percent growth of 24.67%, which this was the backtesting that started in April of 2021 and only lasted 6 months. So a 25% growth rate in 6 months really isn't that bad. The average growth of all of them was 31.1%, and the median growth of all of them was 42.63%. Or this is the growth of SPY rather. So the average SPY growth for these time frames was 31%, and the median growth for SPY over this time frame was 42%. So we can see both the median and the mean and the median were quite significantly higher than for these VoEx backtests than for SPY over the same time periods. Like I said before, for the ones that experienced negative growth, although there weren't many of them, there were still some patterns noted. So one of the patterns that we saw was that the negative predictions outperformed the positive predictions. And this makes sense because VoEx, since it measures instability, and VoEx spikes are inherent indications of like surges of instability. Well, the idea that an unstable stock probably doesn't go up, although sometimes they do. GME, right? So, but negative predictions outperformed, and this tracks with what VoEx is trying to measure, and kind of just makes sense. One of the interesting things, though, was that a full exclusion of the positive predictions was actually detrimental. So the best performing overall were those that included both the positive and the negative predictions. And there was some evidence to suggest that it's actually like exposure to the VoEx spike, or the amount of VoEx spikes you get to play with, that really has a direct correlation with the growth of your portfolio. So especially since the positive spikes were very few and far in between, about only 20% of the VoEx spikes were positive, that came with positive predictions. So it does seem to be in some sense of the more VoEx spikes you get to play with, the greater your returns. And so, yeah, so removing the negative or the positive, or like the negative only backtesting didn't outperform the positive only, negative only, sorry. So the market scan, so we got to talk about this because it was an integral part of the backtest. So all of the VoEx spikes that were delivered to the backtest were done from the market scan, and the market scan is something that Deep Dive Stocks still does every day and delivers right to its members. So it's a market-wide search, and it looks for 3 key events. It looks for stocks that are in a gamma squeeze. It looks for the VoEx spikes, or stocks that have experienced like these sudden surges of instability. And then it looks for another VoEx metric, which we'll talk about later, but it's the persistently overexposed VoEx. And these are stocks that have just this persistent level of instability, or this mounting level of instability, but the system hasn't unraveled yet. So these are good stocks to keep an eye on, because they typically experience some large unraveling event, which can be pretty profitable if you catch it at the right time. So this is an example of a market scan. So it gives a list of the VoEx spikes that have occurred on that day. So for instance, this is the market scan from March 21st, 2020. And we see that these two stocks have experienced VoEx spikes. And the initial VoEx, it lists the initial VoEx, it lists the spike amount. So these are negative spikes. So that means the VoEx spike shot down. This is the closing price on the date of the VoEx spike. And this is the current closing price. And then the change in the closing price. From the current to the closing price of the spike. This market scan, ironically, does only include the negative predictions, but this has been patched, or is going to be patched, to start including positive predictions as well. But we can see it's a pretty handy tool, so that you don't have to spend all that much time scanning the market for these events, when the market scan can just do it for you. It's driven by an algorithm. The results are there, the data are there, and it gets delivered right to you. So in conclusion, VoEx spikes are just a measure of this sudden instability. It's powered by VoEx, which is, I love it. It's deep dive stocks. Like, it's my favorite toy. There's good statistical backing for these VoEx spikes, right? So there's good empirical data to show statistical relevancy. And then the back testing, all 48 of those back tests did outstandingly well, right? And the ones that didn't do well, the ones that did lose money, those were all the positive prediction only, if memory serves, VoEx spikes. Like, that's the VoEx prediction cohort. And yeah, so the backtesting did super good. And the good thing, the convenience of it, is that we can scan the market for these events, and it's simple. We just look for the criteria that were mentioned earlier, and if those criteria are met and it meets the statistical relevancy threshold, bam, it pops up on the market scan. Not too shabby, right? So thank you for coming to Deep Dive Stocks Talk on VoEx Spikes. I'm Justin. If you're interested in this type of data, interested in what VoEx does, I would definitely recommend heading over to deepdivestocks.com. I have obscene amounts of information on both the market scan. There's a whole market scan primer. There's a whole, it's like 30 pages long. There's like another 30-page long research report on the back testing if you really want to dig into the data and take a deeper dive than this introductory video. I highly recommend it. Yep, thank you for coming. Please don't hesitate to, but please like, comment, subscribe if this is information and data that you are interested in. And yeah, that's all I got for you guys today. Thank you for coming, and have a good one. Happy trading.